Fantastic. I feel like we could talk about AI for the rest of the day. Unfortunately, we have a very packed agenda, but actually the topic still remains technology, the future of blockchain combined with AI, and we are really, really lucky to have one of, in my opinion, most influential and interesting female leaders from Switzerland, Lili Liu, the president of the Solana Foundation, here with us today, giving us her view on what's the future looking with Solana.
All right. Hi, everyone. All right. So I consider this to really be back to the future because I think this is what crypto has always been about. I think that all of crypto, there is the asset applications, there's the asset-based use cases, and then there's the infrastructure-based use cases. I think Bitcoin is the asset, and the question for everyone else is who's going to be infrastructure for global financial markets infrastructure? Who's going to provide the infrastructure for that to do for finance what internet did for content, which is everyone all in the same place, all the content on the same rails, and the analogy being all of the money on the same rails. And so there's so many things that go on in crypto, so much research, so many white papers, so many modular architectures, so many all of the above. But if we get back to basics and what we're here to do, now that we understand what Bitcoin's role is, who's going to be that global financial markets infrastructure? So what we've been talking a lot about is internet capital markets. So let me get into this. Today's capital markets don't work for everyone. You've probably seen this fellow before, Larry Fink, one of the scions of US and therefore global capital markets. And he hears it from nearly every client, every leader, every person. They're more anxious about the economy than any time in recent memory. Understand why? We've lived through moments like this before. Some in the long run, we figure things out. Well, easy to say if you're sitting at the apex of the pyramid. But if we just talk about America, there's been a precipitous decline in people's faith in the economy and the future of the economy. 50% believed in the American dream in America in 2010, and today that's 27%, so 50% decline in 15 short years. So what's going on here? The takeaway here is that your freedom is hyperinflating. What do? You invest your time in order labor to get capital, and then at some point you want to invest your capital to rebuy your time. That's how we live our lives. That's what we invest in ultimately. You invest in improving the quality of your life and the freedom with how you spend your time. And in 1971, about 50 years ago, it took 25 hours of work to buy one share of the S&P 500. And what's happening now is in 2025, you have to spend 200 hours in order to buy one share of the S&P 500. So when we talk about, why is it that now all households need to be dual income? Whatever happened to a house, a car, a suburb, one income? Literally cannot do that anymore, even in some of the most elite and prosperous places in the world. So what has happened here is over time, labor just decreases and decreases in its purchasing power, not just of goods, but labor decreases in its purchasing power of buying your own time back later in life. What's happening here is, why is this happening? Where is this coming from? Why is there so little upward mobility of labor these days and the ability to convert labor into capital to then, at your leisure, convert your capital back into your own time? Well, one of the reasons is because the sources of upside in the economy at large are increasingly only available to folks that have large capital bases and can invest in private markets. So Bill Gurley, one of the scions of the other coast of America, Silicon Valley, well, he talks about IPOs being delayed. Now it's typical that companies are private for 10 years. And so what happens is all that upside between day one and year 10 goes into the pockets of someone like Bill Gurley. Got nothing against Bill Gurley, but if you look at Uber and you look at the capital distribution that happened there, how is it that the first 100 drivers of Uber Black at the time, they literally just got paid $20 an hour and that was it. And they did a lot to build the network, but that labor never converted into capital. And so what you have here is 8x, right? S&P 500 has grown 8x faster than the hourly wage. And to translate that into another number, you'd have to be earning $250 an hour, working 40 hours a week as well, in order for your wages to keep up with the growth of the S&P 500. And this is why labor no longer converts into capital, which means later in life, fewer and fewer people can convert their capital back into buying their own time back. And what makes this worse is that gains are privatized while losses are socialized. And so we all know what happened in 2008, and $750 billion at the time was considered actually affordable. And then we did $2.1 trillion for COVID in 2020 and 2021. And so as capital markets appreciation becomes available to a fewer and fewer number of folks, we also have, as we all admire today, exploding public debt and the socialization of those market failures amongst an entire tax base. This is not a pretty picture. And going further on this, what you have over a broader period of time is increase in national debt, 840x. I mean, these numbers, I don't even know how to comprehend them anymore, right? If you look at these numbers, you just think, what am I supposed to do? I mean, I guess a number of people in our industry have come very simply to the conclusion that you just buy Bitcoin. And so labor, doesn't convert into capital very easily, even in the most robust innovation market, where if you've ever tried to do business and give out stock options in America, Section 701, I mean, have fun with your lawyers. And this is why folks like the first 100 drivers at Uber, they just got paid $20 an hour, and all of the folks that actually built the network had no way of getting upside in that network. What's worse, we spent years and are still continuing to spend nearly a decade fighting over contractor labor law, okay? All right, so I think a lot of people recognize that this is an issue, but then you have an incredible divergence in how people ascribe a solution to this. You'll all be familiar with the folks that talk about universal basic income as a way to compensate for the fact that this labor to capital conversion is no longer working as well as it has. And particularly many proponents of AI are going to say, well, you just got to pay someone, airdrop $5,000 a month, and we're all going to be okay and pursue our passions. I have a different perspective, which is UBI, instead of UBI, UBO, which is universal basic opportunity. So recalibrating for inequality of inputs rather than equality of outputs. And I think this is one of the broader ideas that crypto's talked about from the very beginning, which is how do you create and scale new ownership models, community-based capitalism, right? And I think this is what is even more topical now as we're facing this choice as the Western world. Do we want to go down the path of a welfare economy, or do we want to go down the path of an ownership economy and try to rein back in this inflation of labor versus capital? So two ways to talk about this. And when people have typically talked about financial inclusion in crypto, they've always talked about the buy side. The buy side is, the typical narrative is, out of the 5.5 billion people on the internet, the vast majority of those folks, probably 4 to 4.5 billion, live in uncertain economies with questionable monetary policy, high inflation. And so with broadly available internet-based bank accounts, if you will, anyone can have access to assets that are not their local, somewhat unstable currency. That's the buy side. We call that financial inclusion. We've all heard that narrative for about 15 years now, and it's a pretty good one. The other part that people don't really talk about is sell-side financial inclusion. And the simple fact that many issuers are completely locked out of global liquidity, and even in the most robust capital market, which is the United States. All right, so let's talk about both sides of this when it comes to investment assets. So lowering the barriers for investors on the buy side. Well, private markets are private. And the IPO backlog is very real, and the kind of direct S1 path is very limited these days. It takes about 10 years, $15 million, and that's part of the reason why you see a lot of energy around RTOs and SPACs as sort of an indirect way to get to that thing that everyone wants to do, which is tap into broader liquidity, global liquidity. And what this also does is it concentrates the demand for investment assets into a relatively few number of assets. And so this is why the Mag 7 is 1/3 of the S&P 500, because the supply of assets available in this most liquid the most liquid capital markets is the supply is not increasing with the amount of demand that people have for those assets. So what you have is the assets that people can get, they're all getting maxed out. And so where is that money going? Well, one of the places it's even going is into crypto, and that demand, the liquidity is so great that you can even imbue things with zero value, like meme coins, with price. And alternative assets aren't even alternative anymore because folks want to get access to so-called private alternative assets. And that's why with tokenization, one thing you'll hear often is one of the biggest opportunities is alternative assets and private fund tokenization. There is one public market, however, which is widely available. It's called the blockchain. It's on 24/7, and there's a whole range of assets that you can't get in the traditional world. We can talk about, everyone will have their opinions about asset quality, but if you project beyond that and think, okay, as infrastructure, as access to capital markets, as global access, anyone on the internet can have access to capital markets, that's actually very interesting. And what you have here is the traditional kind of stack of how you get onboarded into capital markets has now essentially been replaced with download an extension, whose icon is a ghost. And in one wallet, you can have everything from your meme coin to your money market fund. And this is what it means, global capital markets, all of the assets and all the ways to use those assets in the same way that we accept now on the internet. You'll have the full range of content on the internet, and you can choose the applications and the content you want to interact with. So what this is doing is it's taking the whole range of different ways that assets are issued, oftentimes actually on paper. So fun fact, Animoca you've probably heard of before. They were at one point listed in Australia, and now in order to trade their shares, you literally have to take a pink share certificate, put it in the mail, and mail it to the person that wants to buy it, and it's still very actively traded. So again, indicator of demand looking for better infrastructure. Okay, so now let's talk about the sell side. This is what it takes to IPO today. So if you are going to IPO in the United States, be prepared to pay $10 to $15 million. That's in direct costs. There's also all of the indirect costs. Who gets rich off of this? Ultimately, the lawyers, risk adjusted. And there's many folks who are competing for this exchange business, right? We see Texas starting an exchange. There's myriad small exchanges here in Europe, but you have liquidity fragmentation, asset fragmentation, and as a result, what's still happening? The best companies in the world, they typically go IPO, wrap themselves in some sort of overseas structure through Caribbean islands in order to go list on the US stock exchanges, NYSE and NASDAQ, because that is where you have the most scale capital markets. And so the answer of, well, I'll try to attract more companies to my country and get them to list, it's not you just can't compete on liquidity, and we've seen that over so many years. And the power of liquidity is something that transcends really even kind of national competition, right? If you think about China versus US, how is it that the best entrepreneurs in China, they all want to go IPO in the United States, right? Just think about that for a second. Well, there is kind of an answer, actually. There are, in addition to S1, there are other routes for being publicly listed. There is, of course, compliance, legal, various regulatory work to be done around this, but there are already other pathways to raise less money, do a more simplified offering to a different set of audiences. And so, how do we make these routes more accessible for folks that are a maturity of less than I've been in business for 10 years with global scale? And to an extent, people have tried doing this, direct listings. How do I do something other than the Goldman Sachs-led 5% IPO? There are some companies that do direct listings, but these are companies that already have such broad retail distribution in their customer base that effectively their products have marketed themselves to capital markets indirectly and implicitly. So the question is, how do we do more of this? Direct listings using different frameworks that open up the IPO pipeline. And that is what we are working on with Solana. I think that crypto has never just been about launching more tokens that fly and then they die. It's always been about financial markets infrastructure for the whole range of assets, and that's going to be from the things with all price and no value, like meme coins, to the things that are all value and no price, which, sorry, is most of TradFi. And the thing that is really in the middle, if you want, the one time you want to be mid-curve about this, is equities. Has value, can command price. And that's what we're all about, all the assets and all the ways to use the assets. And so, what we see today is most of crypto, the $3.5 trillion, is on this end of the spectrum. All price and no value. Then you've got, over the last year, with all of these different RWA, tokenization plays coming on the market and into public chains, which is a huge evolution from even a few years ago, you've got really loved assets from very trusted issuers, such as the BlackRock, such as Franklin Templeton, who is here at this conference as well, to really sort of create a pipe between traditional markets and liquidity and the blockchain. That's fantastic, but then what about all the other things in between? How do we fill in this asset spectrum? And those are the types of things that we're working on. And so we're sort of targeting the middle, equities, and then if you can get that right, we'll expand from there. And equities, not just in terms of listing of existing stocks, also being able to do direct IPOs on chain, I think is really the near-term ambition here. So ultimately, I think why we're here is there's no superset of liquidity which is larger than the assets of 5.5 billion people on the internet. And when engineers will talk about single state machine, I think what that means to markets people is unified liquidity and the network effects, the power laws you get by doing that, creating architecture that supports the number one thing that all financial markets thrive on, which is liquidity. So where I think we're going to be going from here is, look, I think tech has always been about unleashing long-tail supply and demand and being able to match those. And that's what we saw with, for example, Uber. There's always been long-tail demand at any moment, at any point in time for riders and drivers, and then new technology helped match those folks. And I think that's where we're also going with markets. Capital markets are now going to be a commonly embedded feature across a number of different consumer applications. Everyone is going to be a trader. You already see this as being a phenomenon in many parts of the world. Every app is going to have an embedded wallet, so every app is now going to be a finance app. And also, anything can be a financial asset. So why is it that gold mines that are in, for example, Kazakhstan cannot directly tokenize, issue their gold as a commodity or equity around their gold mining companies as an equity that's accessible to global markets? So the end state here is bring the fun back into finance. Tech finance has been very vanilla. We got LBOs, we got junk bonds in the past, but recently the greatest innovation has been YC safe notes. And what you see in crypto is you have that convergence of finance and fun. And I know it doesn't always work out, but that is part of the process of innovation that we are all undergoing. There's going to be some winners and some non-winners as well. And this is the end state, all the assets, all the ways to use those assets. So that's what we mean when we talk about internet capital markets. Thanks.